Mic check. Okay. Hello, traders. Sorry about that. Just want to do a quick mic check, make sure that everything's good on this end. But welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, February 1st. Welcome to February Trades, my friends. Pooja, thanks for the AV is good there. Thank you for that. Kelly, great to see you in the room, saying, have I told everyone that I'm happy to be back home, especially back trading with SB Trade Desk. Feels great to be in with the team. Kelly, it's great to have you back, man. Peter, always a pleasure. We'll definitely take a look at the DAX. So we're kind of shooting blanks here as we start off the month. Interesting moves, adverse moves in pound CAD and pound dollar. I was talking about that last night. I was looking for the hold on pound. Got stopped back at the got stopped out with the rest of that trade. There was half that was still on, so we took a little hit on the overall margin gain on that one. Dollar yen just skirting our stop in overnight trade, so we're still in that one, but still looks pretty precarious here. Bottom line, we're just starting off a new month. We have non-farm payrolls on tap tomorrow, and there are some very interesting dynamics we'll go over today in the markets for some of these levels and some of these setups. What I have on the menu for today, dollar sterling, CAD, dollar yen from last night. Euro still holding its weekly opening range. Aussie has been the best performer of the setups that we've been tracking this week. Even Kiwi did go through resistance but pulled back pretty sharply. That's coming off, putting Aussie Kiwi in a straight nosedive lower. And certainly that's going out the bottom of the range. And at the end of the day, Aussie Kiwi, guys, if it does break the monthly opening range to the downside, there's a lot of room. So we'll take a look at that as well. Bitcoin also resuming its breakdown as expected, noted earlier this week. And Aussie yen, which also has continued to follow suit. You saw a little poke through our near-term median line resistance before reversing, but Aussie yen rather, on the way down. And we'll add DAX to that. Pete wants to take a look at the DAX, and certainly that's something that we presented earlier in the week, so we'll take a look at that. Any other questions or trade setups, guys, as always, feel free to throw them on the message board at any time. Non-farm payrolls are on tap tomorrow. Just a quick note on that. We're expecting a print of 180,000. That comes off a previous read of 148. Remember that disappointing read we got last month. Unemployment widely expected to hold at 4.1%. As always, keep an eye on the labor force participation rate. You did see a downtick in that recently, so certainly we'll want to see that hold. Pete wants to take a look at the Pete K, not Peter X. He wants to look at SPX. So as you know, I don't really intraday trade SPX per se, but we'll definitely take a look, Pete, before the session's over. Also, quick reminder, we do have some data on tap at the end of this webinar. You do get ISM figures from the United States around 10 o'clock. And again, Jamie will be on tap with the midweek strategy webinar, guys, at 11 o'clock as scheduled. Okay, should we jump in? Let's do it. Here's what DXY looks like. So this thing, you have to take every dollar pair on its own merits. We've been trying to use this sort of a barometer for gauge for dollar price action. You've seen that the dollar has, in fact, rebounded versus the Aussie, something that we've been looking for a while. Aussie, we're looking for that resistance tag or break of near-term channel support to give us the downside. That has materialized, but certainly you're not seeing that dollar strength reflected here in the index. And that's, again, mostly because this is a 60% weighted euro index, and euro dollar just hasn't been able to make any progress. So look, we've talked about the index at length all week long. Me and Jamie keep going back and forth about it. Put a gun to our head. The broader picture still remains bearish. Remember the broader sequence that we've been following, and certainly the analog from 1994. We've been going over that. Suggests that you could see sideways to higher, but ultimately looking lower. I don't know if you guys are getting sick of seeing this, but I'm going to keep showing it to you because it's something that I've been watching. Both me and Jamie have been watching very closely. So, based on this analog, both in price and time, it looks pretty damn good. Okay, for a sort of a hold, maybe some lateral sideways to higher before finally moving lower into that 88, 88.26 level. Those are the levels that we've been targeting on the short side for the index. So I still think you get down there. We're just opening up the monthly opening range, so you could see a little bit of a pop, could see some sideways action, but at the end of the day, we're basically still looking for the dollar to push lower. So with that in mind, does that mean we take a carte blanche dollar short position against the board? No, because again, each trade needs to be taken on its own merits, and we'll go over those individual setups. But Things to keep in mind, or things to keep an eye on here in the DXY as we close out the week. Obviously, price remains in oversold territory on a weekly basis. As long as that condition remains, the propensity for the market to keep going is still there. So we'll want to see that recovery before trying to make any assertion of some sort of near-term low in price. At the same time, these are stacked up here from the 88 handle all the way into 88.26. That's the 50% retracement from the entire 2011 advance. You have the lower sliding parallel here for the same slope, 2 touches, 3 touches, and the lower median line parallel of the broader slope actually comes in just lower, and that's the 88 handle. So key region, okay, to keep an eye on as far as near-term support here for the index, resistance and broader bearish invalidation. The only thing that would put me straight bullish would be a break back above the 91 handle, specifically 91.33, the low week close from last year. So the broader picture hasn't changed. The question is, in the meantime, how do we deal with this? Well, here's what the daily chart looks like. Still an oversold condition, nothing to really prompt any long type of dollar exposure, specifically on the index per se. The weekly opening range has been exceptionally tight. Again, we're just opening up the monthly open, so keep the powder dry here for a little bit. Reviewing last month's price action. Sorry, guys, looks a little lag here on my end. You could see a very clear monthly opening range. Here's your monthly open. You set a low, you set a high, you break the low on the 12th, and certainly we put in a low pretty damn close to the end of the month. So let's respect the range. We're just opening up the month. 88.27, 88 near-term levels of interest for support targets on the way down. Initial resistance right now, well, we tested that basically this week. Here's the intraday chart. And this is the intraday chart that we've been following essentially since the start of the week. Here's the last update from the 30th. And here's your weekly opening range. 89.55 was the level that we talked about early in the week as resistance. We tagged that twice, pulled back, and we're just sitting in that range right now, just above the 2010 high. Again, downside break 88.27 and the 88 handle are going to be your near-term targets. Near-term bearish invalidation would be 90.11. If we break through that, then that 91, 91.33 level would be your top side targets. But all things held constant, I'm basically still looking for a move lower in the index. Any questions on this? Keep an eye on this, specifically heading to the first major event risk basically for the month with non-farm payrolls. Just as a side note, guys, I don't necessarily think you're going to get crazy amounts of volatility. And that's basically where we are with the monetary policy environment. Okay, the Fed is really more focused right now, and we've been saying this for months now, but it still remains constant, of the Fed's dual mandate of price stability and maximum employment. Arguments are being made that we are basically at full or the natural quote unquote rate of unemployment. So the focus is on the inflationary pictures. Look for wage pressures tomorrow in that report to see if we're getting a uptick in any type of wage inflation figures. But as far as non-farm payrolls, look, 180 is the expected. I would say anything sub 150, you'd start to see an adverse reaction. If you do get something north of 200, well, you probably at that point start to expect some sort of near-term rebound in the index. Keep in mind a couple of things. Markets are all but pricing in an interest rate hike in March, which is the next FOMC policy decision. It is a quarterly decision, and also it's going to be Jerome Powell's first as Fed chair. So certainly, the expectation is there that we'll see that first move start to materialize in March. If underlying economic data starts to come out much stronger than anticipated, the risk, guys, as far as the markets are concerned with monetary policy, the risk is that they start to hike more aggressively than expected. There are some people calling for 4 hikes this year. So the underlying data, specifically with employment, and more specifically and more importantly, the inflation data is really, I think, what's going to be the main catalyst here for the driver. So just some notes there on the DXY and broader dollar performance heading to tomorrow's release. Again, expectations are for a print of 180,000 from our previous read of 148. Questions, comments, concerns on the index? You can see that basically the slope that we've been following, resistance, nice pivot along the median line, lower median line parallel, support, resistance, little breakthrough, but here we are with resistance again. If we make it through the 2010 high, 88.71, look for 88.27 in the 88 handle. Okay, moving right along. Let's jump into the pound. One thing I did want to just touch on, guys, we're not really big on getting too deep into the fundamental analysis and all that stuff because we're traders at heart. Me and Jamie, we've been doing this for years, and we kind of want to filter out the noise. But one thing, and I'm sure Jamie will talk about this in his webinar later today as well, one thing you want to take note of is the crazy radical rally that we've been seeing in yields, guys. TNX. So if we just take a quick look at the 10-year note on the daily chart, forget the intraday, just to put things in perspective, on where we are. Markets have now reached levels that we haven't seen since 2014. Now, the interesting dynamic, guys, that's happening with yields is that obviously yields move inverse to price. So the fact that you're seeing yields move higher means that there's a sell-off in the bond market. What does it mean if the bond market sells off, right, the smart money, but at the same time you see a correction in stocks? And certainly, I'm not necessarily saying that stocks are going to tumble from here, and we'll go over the SPX and the DAX in a little bit. DAX a little bit more convincing that we are seeing some precipitous downside really start to mount. What does that mean? That typically means, and I don't want to be a fear monger guys here, but that's typically not a good sign about broader market sentiment. Your historical view is that when markets start to sell off, specifically on the risk side, you see a rally in bonds, which should drive yields lower. But what do you do when yields are just ripping higher and stocks are, if not rallying, starting to tail off? The beginnings of a possible, near-term larger pullback, maybe. I don't want to be that guy calling for it because I'm sure throughout this whole rally in the markets, there's been always a guy jumping out and saying, oh, we're going to reach a top here. And I'm not saying that that's necessarily happening, but definitely the risk is starting to surmount. And the more you see bonds start to sell off, i.e. yields climb higher, the more you start to get concerned when you see market sell-offs, because that dynamic, it's a concerning one. It's a concerning one. You think about it just kind of on a logistic type of objective kind of logistically, risk, okay, you're in stocks or you're in equities, you pull out that risk. If you're not putting it in bonds, the safer, quote unquote, asset, well, where the hell is that money going to go, right? Could help some fuel some dollar strength, could help some fuel some extraneous assets. And specifically, what I personally think is that you'll see a lot of that money start to tumble right back into commodities. Think about it. If the risk markets are selling off or people are trying to avoid equities, bond markets, are, really trading heavy because yields are super high at this point. Where's the money going to go, right? So you should be able to at least see some interesting strength and support in commodities, whether it's gold, maybe silver. But it's a very interesting dynamic that we'll go over again. We'll continue to monitor, but it's something you do want to take account of, guys. And specifically, if we see that the obviously yields now have broken to multi-year highs, but if we've continued to break higher in yields, meaning lower in bond prices, if the equity markets do turn over, that's certainly a very alarming dynamic to keep in mind. Okay, just to put things in perspective there. So with that being said, let's jump back into the dollar crosses. This is something that we're paying attention to on the broader theme of things, but looking at this more objectively, here's where we were, or here's what we've been following over in the pound. Where's my pound setups? There we go. Okay, so sterling. Well, we got stopped out on the rest of that trade. Here was the sterling trade from last night. I took a stab basically at the 618 retracement from the decline off the highs. It was 142. The initial rally that we went to right here, it looked pretty decent. Momentum on the near-term prospect was holding right at 60. And once we pulled off, I took a stop against this Friday high from last week. That's where the stop initially was. We moved lower. We got, 35, 35 is where we exited, 141.35, so almost 70 pips on the way down. Then when it rallied, I had moved, once we took off half that trade, I moved the stop back up to yesterday's high. And an overnight trade, obviously, shortly after writing that report, we broke through that. So I'm out of that trade now. Net gains were obviously kind of contracted because we took a stop on the rest of that trade. But at the end of the day, we're still moving higher. You're looking for 143.56 into 144, the same levels we were talking about. To start off the week of where we would want to look for a possible exhaustion trade in the sterling. So, sterling's one of those trades where the longer term picture is super duper clean. The question is, how do you attack this on the near term prospect? And while above 39.52, I've still been working with a constructive outlook. My objection or my play or the game plan for this week was to look for the near term pullback for a nimble scalp on the short side, eventually to get back on the longs. Guys, I think sterling sees like 150s this year, no problem. So when we take things into consideration, we're still an overbought. It might have been a little bit overzealous to try to fight that yesterday. Like I said in the report, I felt like I was fighting the trade the entire time since we got in. We still took a net gain on it, but at the end of the day, it's just not worth it. Better off to play with the trend than try to go against it. So for the pound, obviously the weekly charts are very, very clear. Here's your major resistance on the near term is 144. You have the long-term 200-week moving average and the upper median line parallel. It's almost where we maxed out exactly last week. Key support right at the median line, again, the 38.2. You have former swing lows just below that. 39.50 is basically 39 handle on the longer term. So weekly chart still perfectly clear on the index, on the sterling. Daily chart, well, you're seeing momentum start to wane a little bit. I'm still of the mindset that, if we get some sort of correction, 39.43 would be a great area to try to get back in along that median line. But I'm not willing to take another shot at this point. I think I want to wait a little bit more. We have the BOE on tap next week, so the Bank of England interest rate decision should offer a little bit more of a volatility kick on this one, I think. And there's nothing really left to be said here except the trend is higher. So until we get some sort of near-term pullback, guys, if you're long, hold it. If you're not long, I can't really advocate trying to chase this at the highs of the year. So that's my problem with sterling. It was worth a shot, I think, yesterday. And that pullback, even if you look at this in a much closer time frame, even the 120 minute on that stab into the 42 level, which was that 618, this is where we took the short. Perfect hold that momentum at 60. That's like exactly what you want to see after probing into oversold condition. So I thought this was worth a shot. Again, the pullback did offer us a nice little play on the downside. Even that when I exit a little bit early, we got as low as 141.20s and change. We got at 141.35. But at the end of the day, the pull higher here, then we pulled back into the close of US trade. My stop was against this high. Stopped me out and pulled back. But look where we're finding support again. Same level, 42. So from this point forward, I wouldn't be too surprised to see this thing run back into 43.50, maybe even the 45 confluence or the 44 level confluence region before pulling off. But, I'm not willing to necessarily fight this trade at this point. So I'm going to let this one take a little bit more neutral stance here. The trade for me would be if we get another spike into this region, look for a possible fade opportunity, real near term. Or if we do get a breakdown towards former slope resistance, 42s against 39.43 would be really where I'd be looking to take along to try to see if we can't get that topside pop. Questions on sterling? Not really my favorite trade at this point. So we'll see if we can't get some clarity in price here. So pound CAD was the other one that we highlighted yesterday, and this is one that we were looking at since the start of the week. It was a beautiful play to the long side last week. We were looking for exhaustion along the upper median line parallel or channel resistance. We got it. The initial breakdown here was a nice, convincing reversal candle. And certainly to start off the week, we said, look, as long as we stay below former channel support, you're basically looking lower. So once we made a 38.2, you saw a perfect support bounce there. Here's where we were last night. And, as long as we stayed below 74.91, which is the high day close for this year, right? Real near term. I thought it was worth a chance to try to get another entry in the short side. There were no triggers, even in near-term price. Here's a 30-minute. There were no triggers to help me get in on this one. So luckily, we didn't take that bait. And now that we've broken through in that essentially the objective weekly opening range highs, I do still think that the risk is still for, rally towards 176.40, and we'd look to reassess there. 176.40 ends up being a nice confluence of the 1618 extension, okay, of the advance off the lows here just near term, and the objective yearly high so far. So 76.42, 76.34, break through that, and you're looking for the Brexit exit, or the Brexit close at 77.30. All things held constant at this point, on an objective break of the weekly opening range, I still think, while ultimately I want to see a bigger pullback here, the evidence is just not there for us to try it yet. Okay, so we'll have to reassess pound CAD as we open up next week, see how this thing closes out this week. But at the end of the day, this is still the risk for a move higher back towards basic channel support. Puja, any resistance in euro yen near the high we just made to justify looking for exhaustion near term? Euro yen, let me write that down. Okay, I got you, Puja. Any questions on pound CAD? And again, just to put things in perspective on where pound CAD is on the weekly charts, this is where pound CAD looks like right now. Keeping in mind, on a broader scale for the stretch higher, if we were to make a basic 38.2 retracement, keep in mind the high week close is just lower. The high week close actually comes in at 177.06. The retracement comes in at 177.27. That's also the Brexit close. That's also the median line for the current operative structure we've been following. Okay, so on the way up, that's sort of still a level of pretty strong resistance that you're going to want to keep in mind if you're holding long exposure on pound CAD. Ultimately, if we do see some sort of sharper reaction here, it might be the downside play. But we're going to shelf this one for now. Last but not least, from yesterday, dollar yen. Here's what the yen ski looks like. The abomination doing abomination things. Here's what it looks like first on the weekly charts, I guess. The focus for this whole week was to get a drop into this godforsaken region between 107.83 and 108.17. Has been, the former swing lows from last year, early in the year, specifically in April there. Then we had the low week reversal close. That was 107.83, excuse me. Both of those levels converge on basic trendline support off the 2012 lows. 2016 lows, tagged 3 times that year, and here we are again. So we didn't quite get the drop into it. I still think you can, but that's the real level of support, major area. A break below that, you're looking for a 618 objective, and that's 106.37 or so, 38. I know Jamie's looking for initial targets on the short near 106.44, 106.60. So a little bit more on the inside, a little bit more prudent. He's playing it, but that's the risk with a break below this region. As it stands right now, we haven't gotten that tag yet. So on the weekly charts, well, starting off a new month, near-term support is just lower. That's the level you're going to be trading against, whether it's a break on the downside looking lower or whether it's a rebound. It's all about that region for me near term. On its face value, it's always important to keep things as objective as possible. And looking at this just over the last 4, 5, 6, 8 months, you're simply in a range. Resistance, support, resistance, a little bit deeper on support, resistance, support. Okay, so puts even more added emphasis if we break below 107.80. That's the weekly chart, right? You got a momentum trigger break here on the weekly charts last week with the close with that move below 110.15. 110.15 is still going to be our near-term bearish invalidation. So make it through 110.15. I'd be a little concerned. Questions on dollar yen on the weekly. Here's what it looks like intraday. Okay. Daily chart, just highlighting our bearish invalidation level, which is still 110.15, 110.23. You want to stay still looking lower below that region. Here's the intraday price action, and this is where the trade idea that me and Jamie were working with, we want to stay bearish essentially below this slope. For me, the level I cited to you guys was 109.55. I wanted to see price advances hold below that. Now, Here we are with a spike, and if this does end up being a 4-hour outside reversal candle, means we close this hour below 109.30. I would forgive that as an exhaustion trade. Momentum basically stalling right at 60 could still work out. So I'm still not giving up on that swing trade that we're in, guys. Remember, your stop is just higher at 109.80. And basically, we're looking to see this thing, if it can't pull back, to get us back below that 109 handle. Downside target's unchanged. Again, 108.16, 107.83, 107.45 is the last target. That's a measured move off the highs. Questions on dollar yen? Broader bearish invalidation, still 110.23, 110.15. Okay, so not really our favorite setups anymore. These were the last three setups that we highlighted last night, kind of shooting blanks on them. Dollar yen's the only one that's still kind of feasible right now, but sterling breaking higher, sterling CAD breaking higher. Don't really want to touch those until we get a little bit more conviction on what near-term price is saying. Moving right along into the majors, here's number 4 on this session, euro dollar. And if you're as frustrated as I am, we're on the same page. This thing has done nothing since the start of the week. Here's your weekly open. You're mildly higher on the entire week, despite all the hoopla back and forth. But you continue to respect basically the median line off the lows from late December. Support, 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 break, saw acceleration, breach, saw acceleration, support, 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 support. Weekly opening range high still unchanged. That basically lines up with the 50 line right at 124.70. So for euro, it is what it is, guys. At this point, you need to treat this as an objective weekly opening range. If it breaks higher, look for 25.38, 125.98. My opinion, humble opinion, both of these, if reached, would be levels of interest for at least a near-term exhaustion trade. But I would have to say, based on what we're seeing with the momentum signature holding above 50 as support, there's really nothing here to suggest that there's a major turnaround at hand, which is why for the euro, or for the dollar index rather, it's tough. It's tough to really try to look for a stronger rebound there, because this thing just looks like it's remaining still constructive. And this type of advance consolidation into the median line is exactly what we saw into the close of January trade. You ripped higher into the upper parallels, broke through, failed. You started to consolidate with some higher lows, with some lower highs, and then you finally broke to the upside. Here we are again. Through the median line resistance, pull back. Now you're starting to make higher lows. You're starting to make lower highs. And if this does resolve again, initial targets 23.80 and 25.98. On a breakdown type of play, if we break yesterday's lows, period, end of conversation, 123.90, 123.88. If we break below that, I would be expecting a drop towards the lower parallel. That converges on just some former swing highs here, gets you 22.96. It's a big ask. It's a big ask, but that's the game plan if we break to yesterday's lows. All things held constant, consolidation break, targets 25.38 and 25.98. Any questions on the euro? Okay, here's what it looks like on the daily charts. Yeah, that basic trend line resistance dating back to the highs that we made in 2008, crisis highs, again tagged in 2011. We did dribble above it in 2014, but on both ends, after we broke through, before we broke through and after, it again offered some resistance. That level gave out with a breach here this month on the 24th. So that same slope, which we did tag and reverse off of right here on the 17th before breaking through, that same slope comes in with former slope resistance for the up channel right around here, 23. And that's why in the intraday charts, you're still basically looking to stay bullish well above 23. Okay, weekly charts for euro, just not to go out of order, but just keep things in kind of perspective. 25.98 comes up on so many different time frames. It's always going to be a big level for me. That's the 618 retracement from decline off the 2014 highs. Basic trendline resistance extending off the 2000, that late high. So if the one that we were looking at on the daily chart was this, okay, and you got play, like I said, on both sides. That looks like it broke, but if we take it just to the more extraneous high that we made in 2014, that converges over the next few days, basically to the end of this month, near 126. Questions on the index. As always, I see some new names here in the room. Welcome aboard, guys. If you ever need to, just remember there's a camera button at the top of the GoToWebinar screen. If you need to take a snapshot of any of these charts or if you need to review them throughout the course of the day, please feel free to do so. So that's Euro on the weekly. That's Euro on the daily. Whoops. And that's Euro on the intraday. No change to any of the levels that we've been following as far as Euro dollar since the start of the week, right? So we checked again that resistance, pulled back into the median line, and we've just been consolidating in this region right here. Bearish or bullish invalidation still 122.96, 123, except in time, based on what we did in price, that gets kicked out right here to the lower parallel. Okay, so let me take a segue real quick and take Pooja's question on Euro Yen because that's the only other Euro cross I have on the list for today. So Pooja, let's take a look at Euro Yen. I haven't stoked it out yet today. Let's see what's going on. Okay. So, in my humble opinion, all you've done here, Pooja, is you've set a monthly opening range. Here's your monthly opening range high. That's basically what you just tagged and pulled off. Monthly opening range, no, never got tested, but certainly on the pullback, the slope has been offering some support. So, look, it's a monthly opening range, period. And the fact that we never saw an objective break of the January opening range just means that that range carries over into February. And again, you're basically looking for a clear 136.60 break to the upside. You're looking for the upper parallel. That's 138, essentially, 137.95. And a downside break, your bullish invalidation is right here. Outside reversal day close at the lows, okay, base gives you 133.80. 200-day moving average comes in at 133.60. Slope comes in right in that same zone. One touch, two touch, three touch, four touch, five touch. That's just ahead of the upper bounds of that zone, 33.80. Now, your question here, Pooja, says, is there any resistance level in Euro Yen near term we just made to justify looking for an exhaustion, a near-term short? So for a near-term short, yeah, I think your stop is pretty well defined at 136.64 or just above that, Pooja, just on account of the yearly highs and the yearly, high opening range that we just tagged and pulled back. The question is, does near-term momentum support that thesis of exhaustion? So let's look at this at a little bit closer of a time frame, shall we? Okay, this pitchfork is kind of null and void here. Okay, let me just cover the high day close for the year. It comes in right there. Scratch that. Now, this is a big assumption. I hate doing this because I don't know that this is a high, right? It could push higher, and all of a sudden we'll keep stretching this and alter analysis. So we don't want to do that. But and the weekly opens right here. Put support right here. So here's a 60-minute momentum trigger. Puja. On divergence, price action making a higher high in price, the oscillator failing to reflect that high in price. Outside hourly reversal. Off resistance, so off the former highs at 36.64. Yeah, I think this looks near term like it could see a near term pullback, at least just based on what the charts are saying. Here's the 30-minute chart. Hasn't broken quite yet on the 30. Okay, it might be a cleaner slope to work with this one. See the median line's resistance, touch at the 50 line, resistance to median line, resistance to median line, break saw acceleration to the 50 line, then we pulled back, upper median line parallel caught exactly, with the basic highs that we just made. So in this case, just on the near term front, Puja, and I'm going on the fly here. Key supports down here. Whoops, I bring that up. Near-term key support would be right here, the slope of which we rebounded off of earlier before the origin of the breakout, the 50% retracement, the entire range from that breakout. It gives you 135.40. On the downside, near-term resistance, now that you have all these slopes drawn out, the cluster all converges basically at the same high that we made, back here in January. Does that make sense, Pooja? Does that help? So 36 might give you a little bit of interruption, all things held constant. I'm looking for a mean reversion back to the median line. If we break below that slope, I think 135.40 A would be a target for the downside. B, it would actually be a nice launching point for a recovery back higher. So Pooja, that would be sort of my thought process here in Euro Yen. Does that help? Does that make much sense? This is the 30-minute chart, really near term. Yes, thanks. Neat pitchforks! Exclamation points all across the board. Cheers, Pooja. Yeah, sometimes you just got to spend a little bit more time with the near-term price action. I know in the webinars we don't get quite enough chance, guys, to get as deep in price as I do, and I get into the trades in and out. But I'm trying to cover as many setups to give you guys options as I can. So This is one where I do think both the area, time, and region of which it turned from does look pretty decent for at least more of a little bit more corrective pullback lower in price. All right. Speaking of pitchforks, by the way, I know we breezed over dollar yen, but I just wanted to highlight one thing in dollar yen. Um, we're working with a couple of different slopes on this one. I know Jamie's working with a slope, a little different slope, but I wanted to highlight that the slope that, although we might look at different slope guys, what we always try to make sure is that the same levels are reflected. So you guys remember, this is the slope that we've been working with for weeks. The median line break saw it as resistance, the lower parallel caught as support, the lower parallel fueled an acceleration, and then it was resistance, resistance. This is what messed everything else for us now. Of course, the swing trade had to stop just against that high, so you're still in that. But the pitchfork I think that Jamie's working with, if I'm not mistaken, is the broader one off of this low, this high, and this high. And the only thing I wanted to highlight is if you draw that, it's almost the identical same slope. Our median line converges on 50 line. Our lower parallel converges on the median line. And certainly the upper parallels are both on the same. So just because we're drawing different reference points, the most important thing, like we always say, is going to be gradient, the slope. You always hear us say the slope is dope. That's really all that really matters. So if you're using different reference points, but the same gradient of the slope is manifesting itself, adds salt, adds fuel to the flame, gives you more conviction on the setup. All right. So that was Euro Yen and Euro. Let's go back to the Aussie. This was the best performer of the setups that we've been tracking this week. It was super, super basic, and that's what I loved about it. I'll take you back to the Aussie from the weekly chart, and we'll move our way down. So, on the long term, here's what we were looking at. Ideally, and this is something I said early in the week, ideally, you get that spike into 81.68 before you turn around. That's a 100% extension from the initial leg up from the yearly lows we made in 2016. Boom, boom, boom. They gave you 81.68. Confluence resistance just with basic trendline support. This is a 1 point, 2 point, 3 point confirmed. Converges right at 81.61. Near-term support at the 200-day moving average. Ideal scenario was to get a spike into here to get short to try to play the downside. That's the longer term whole view on the weekly charts. The daily charts showed something a little different. Okay, we had a real near-term ascending median line or ascending channel formation, really basic, just off the December lows. And you can see that converged on the weekly reversal bar that we made subsequent to the highs last year. That was really right here. That level came in at 80.26 and converged on the lower parallel or basics channel support. So once we broke that, that would have prompted short exposure. As we said from the start of the week, the game plan was either to get a stretch into that 81.50, 81.60 level we just talked about for a short, or if we don't get that first and we see a downside break of the channel, specifically today, look for the close. In my opinion, that would suggest that we are in the near-term correction pattern. Also, momentum breaking back below overbought conditions. And again, that is a near-term short signal. So the daily chart, well, certainly looks like you're at the risk for a more concerted pullback. Here's intraday, and here's the clarity in price. So here's your weekly open. Weekly opening range high is set right at 81.18. You test it twice, you test it thrice. Knee-jerk reaction lower yesterday. You're basically looking for a break below the high day close. Former high day close comes in at 80.54. We noted 80.26. That's the level we needed to break to validate a break of the ascending channel formation, which has held all the way since, basically the start of December. One touch, two touch, whether you call that a touch or not. There's the hesitation. Resistance obviously was 1, 2, 3, 4, 5. Gives us conviction on the slope. So since we didn't get that spike higher first into 81.60, you're basically looking for a break of the weekly opening range that materialized yesterday, looking for a late week low, near-term resistance, and near-term bearish invalidation for the current operative move is 80.54, that same high day close again. Just so happens that slope resistance former slope support, is right there as well throughout the course of today's session in the US. So even if you were to get a rebound, we would need to surpass 80.55 to get back on the bullish side of things. That being said, all things held constant, you're looking lower. Near-term target 79.56. A little bit more of a major support zone, a major pivot in price. Key confluence region would be 78.86 into 78.98. So Aussie, our favorite setups, the only one that actually worked sitting in this short for a while, seems like it's been kind of like counting sheep, but patience pays in some of these updates, in some of these setups rather. Not too sure I want to work with that just yet. But basically we'll give you bearish invalidation right along former channel support, upper median line parallel, and then a downside break. If this slope is in play, you're basically looking for a drop towards that 79.56 level. All right, questions on Aussie. Here's what Aussie looked like earlier in the week. Again, it was that spike into 81.60 or the break below 80.26. Obviously, this reversal candle that we made here was pretty stern yesterday. So looks good. Looks good. If you're holding shorts, by the way, quarter off here, I wouldn't dump the whole thing because we finally cleared that channel. And when you have a multi-month channel like guys like this that is so clean, the breaks typically give you a decent sizable move. So the fact that we've broken below for me is encouraging. Heading directly into the US session. Wouldn't be surprised to see some sort of near-term recovery, but I'd still be looking to fade a rally near 150.54, or excuse me, 180.54. There's no 180.54. Jesus. It's been a long week, guys. So that's the game plan, I think, for Aussie moving forward from here. Questions? All right. Next up is, oh, geez, we're running late on time. So let me pick up the pace here. Next point is Bitcoin. A trade, again, I don't really know, unless you're trading on the futures markets. If you have an IG trading account, they do offer futures positionings on this. So definitely keep that in mind. If you're looking for exposure and you're trading offshore specifically, there are plenty of opportunities. And I know the short Bitcoin or short crypto in general seems like a crazy play, but not when you take into account the basic fundamental outlook that we've been following. And here's what, obviously, we want to take into log charts, guys, instead of arithmetic charts. Well, we're looking at this just because of the sheer size of the ranges. But here's what Bitcoin looked like earlier in the week. The basic play was the fact that we broke this near-term consolidation that we've been in since the tail end of January. Obviously, the 9,300, okay, 9,300. Once we hit that region, remember, we put a report out here saying, watch out, shorts are at risk. Broader picture is bearish, but boy, that's a decent confluence region. You have the lower median line parallel and a key 618 extension, or a key 618 retracement, rather. Those are things I'll pay attention to. And certainly once you got that really strong rebound, it shifted the focus higher. Our bearish invalidation level was 12,801 into 1374. This range here. Look how perfect this played out. You couldn't make that up. Couldn't make that up. Okay, so the pullback took us back below this consolidation region. 1 touch, 2 touch, 3 touch confirms. We even had a 4th touch before the subsequent break. Really confirms a break of this range. Downside targets 90. I can't read my own text here. 93.03. Okay, downside break beyond that. This is the bigger region of support. 8,643, 8,723. Big confluence region from a basic Fibonacci standpoint, the 100% extension from the decline, the 618 retracement from the ascent, and the lower parallel. Again, trade right here. Just below that, I have a soft target, 83.37. Here's what Bitcoin's doing right now. Well, I guess I could show you the daily chart first to put things in perspective. Why that region's so big, 87.28, 86.43. Like I said, basic 618. retracement for the advance off the lows that you made back in July of last year. And secondly, you have the 100% extension from the decline off the highs. I think I have this, oops, drawn backwards, by the way. Nope. Still looks good. For some reason, that doesn't look like the 50, but, or the 618, but it is. So 86.43, 87.28. Watch that level. Just lower is this pivot. This is what I have at 83.37 that I noted earlier in the week. It's just a pivot in price, so don't go crazy with it. But you saw 4-day closes below this before the break. And this is how I study near-term price, guys. And this is not even near-term. This is a daily chart. But how to study levels of significance from a horizontal standpoint. There's two things we look for, right? Slope, and then we look at horizontal resistance and support. When those converge, those are my plays. Those are the plays I'll pay attention to. So certainly this 4-day span where we held below, it doesn't mean anything. But the fact that the day we did close fueled or was the origin of the next concerted stretch higher, that to me is a level to watch. Lo and behold, it converges on basic slope support, extending off the lows, and that comes in again at 83, 37, 83, 38. Okay, near-term bearish invalidation. Here's what it looks like on the intraday charts. Things are super clean. Okay, nothing changes from yesterday. So the near-term bearish invalidation, unfortunately, still needs to be up here. Now, if you're holding short exposure from anything sub the break, so like let's say you're holding anything sub 110, 10,500, anything sub that, I'd have my stop at break even. If your stop or your entry was above that, it has to be against 111.60, guys. There's no way. 111.160, excuse me, or 11.160. Gosh, I can't get my rates right today, guys. I apologize. This is what happens when you get into the fourth webinar of the week. But 11,160 is the break point for me. If we get through that, you're likely to see, if not resumption of the broader uptrend, a much stern and much more concerted recovery in price. As long as we stay below this, the risk is lower. 93 again being tested. This is the yearly lows, the 618 retracement. I do think you get through this. Look for the US Open, specifically if momentum is able to hold below that oversold condition. You're seeing that it's trying to recover right now, but if we do hold below, we have to wait for this candle close. 86.43, 87.28 is going to be your first target. Okay. And then, like I said, just below that is going to be that 83.37 level. Okay, so things look the same, man. Everyone's been bullish as hell on this thing, and I get it. I get the fad. I get all the headlines. The 19,000 run there was something that like millions of people thought that they just missed out on the biggest possible opportunity in their lives. These things have consequences, and these extremes in sentiment do manifest themselves in price. And I still think, on whole, there is further risk for downcline move here in Bitcoin before we start to recover. Okay, questions, comments, concerns on Bitcoin. Moving right along, Kiwi dollar. Here's number 8. Kiwi is a little frustrating for me. So I didn't get a chance to get in. I probably would have gotten stopped out, guys, if I did, because it did surge through our resistance level. We were looking for a hold below 74, essentially 74 into 73.90 was where I wanted to see this thing hold. I was looking for a short exposure here. We made it as high as 74.20. Before breaking down. Now on this breakdown, late before the Asia trade session yesterday, I really didn't know how to play it. The actual play would have been to play a recovery back towards 73.91 with a short against that to try to get the move lower. But the momentum signature, there's nothing here that screams action for me. Okay, if anything, this is indifference, kind of just straddling the 50 level. Not really much concerted breaks above 60. No real moves below 50 of significance. You're just testing the yearly opening range highs. I don't know. Put a gun to my head. I still think you look lower here. Broadly speaking. Now that we've made all this hoopla and all this mess, I wouldn't be surprised to see it spike into 74.80, 75.15, which is the next major area of resistance. That being said, yeah, I kind of want to see this thing turn over. And here's the channel. If you guys remember that we were looking at near term yesterday in the webinar, right? So we broke it as support. We checked that as resistance. And like I said, this was the only opportunity to try to play this to the downside. On that check and failure, your stop would have needed to be against this high. And that's too big of a stop for me. It's over a 60 pip stop. We'd have to break at least below the weekly open. Here's your weekly open, by the way. At least below the weekly open to get this thing going. So you can see that even on the pullback, look where we found support. Look where we found support. Look where we found support. Right? So Kiwi's resilient. I thought it was a downside break of the channel. It looked like it was. Recovery back above, break back below. Has me really looking for a little bit more clarity on this before we get involved again. Let's just see if we have any slope to work with here. Not bad. Support, resistance, and near-term bearish invalidation. I put it right back at 73.91. Questions, comments, concern on Kiwi? All right, 2 more to go. Then we'll jump straight into your questions here, and I promise I'll get through all of them. Aussie Kiwi, really quick. Aussie Kiwi, complete breakdown, right? Complete breakdown. So again, just a quick review. We went through all of these. We went review of the earlier setup. Here's your Kiwi setup. We rallied right back, and we ripped through this, and now we're trying to break back below. So look for that break. Again, 73.07, that level right there. Okay, if we break back below that, it would put me a little bit more of a comfortable short stance. Excuse me. On Kiwi. Till then, it's a range, uptrend resistance. Okay, Aussie Kiwi. Well, we called this one last week. It was a very, very impressive range break trade. We were looking for a move above 110 to really get this thing going, targeting 110.66, 110.67 would have been the 50% retracement. The yearly opening range highs is just below that, and then you got the 50 line here. Well, if you remember this one earlier in the month, back on the 24th, or back on the 20, I wrote the wrong date here, back on the 25th, here is what it looks like. And very, very clean, concerted range, 3 touches of resistance, 2 touches of support. We were looking for that break, topside move, boom, 110.67 was the level to watch. So we got that break. Okay. It rallied into the upper parallel, into that confluence resistance, and things held here pretty sharp. On the pullback, I gave you guys a bullish invalidation at 110. So if this thing broke back below 110, forget about it. It's a false break of a broader descending channel formation. And in such a scenario, you'd look for a collapse in price if we made it back below 110. It's exactly what you got. Here's Aussie Kiwi. On the live charts. Okay, so there's the broader slope that we've been following, right? We talked about the parallels here have been really, really clean. Upper median line parallel broke, but we did go for that confluence resistance there. Once we broke back below 110, changes everything. So we've already taken out the 50% retracement of the advance at 109.58. We've already taken out the 786 retracement, which converges on the lower parallel. At this point, this slope, null and void. At this point, this retracement, for all intents and purposes, null and void. Now we look for some sort of decent slope for the continuation of the downplay. And the only thing I was stoking out earlier this week was this play. Okay, 1 touch, 2 touch, 3 touch confirms we're there right now. So it could get a little bit more of a rebound, but this is a very clean and very objective break of the monthly opening range, or excuse me, the weekly opening range to the downside. Should be looking for a late week low. Now testing slope support. Below this, 108.21, 108.30. But as it stands right now, basically that's where I'd be looking for resistance right now, is right here. So on a rebound type of move, look for 109.64 to really basically cap the advance. Subsequent targets 108.30, 108.21. Questions on Aussie Key? Here's what we look like on the weekly chart. The one thing I wanted to note here is, guys, if things continue as all things held constant into the end of the week, into the close of tomorrow, this will have posted a massive outside weekly reversal. If we clear this week's lows, so if we get down deeper below 108.58, that would be a pretty bearish stance. Outside reversal off resistance, which covers what? The entire yearly range so far. That would only happen with a drop below 108.30s, but basically, or 108 break to the downside would be disastrous in my humble opinion. I think in that case scenario, Aussie Kiwi really starts to tumble. Remember, 108. Guys, can I just get some confirmation that we're still on here? Okay. Looks like my screen is. It was some nice a minute ago. Yeah, sorry about that, guys. Bear with me 1 sec. Okay, are we back, guys? Sorry about that. I'm not going to let this go until we finish your question. So Aussie Kiwi, just keep in mind again that you know that drop right there into possible support 108.30. That's going to be the real break. Notice the 200-day moving average also converges on that 38.2 and slope support. So for me, that not only would be an outside reversal off resistance, but it would also be a break, an objective break of the monthly, initial yearly opening range. Okay, so that's Aussie Kiwi. I do want to just touch real quick. I know I'm over on time, guys. I appreciate you guys sticking it out with me, but Aussie Yen, testing support, 87.58, 87.64, 2016 open, former resistance, 50% retracement. It's all stacked up right here. Watch this today. It's going to be very, very important. Here's what Aussie Yen looks like on the intraday charts. Okay, we were looking with this slope to start off certainly the week. And sorry guys, we are super lag today. And we started off the week saying, look, as long as we stay in this formation, we can continue to look lower. You saw this candle break through, test 88.40, which was our bearish invalidation level, but it failed, right? And not only did it fail, that 4-hour candle closed much lower and back within the confines of that formation. So for example, if we were to bring this into a line chart, you wouldn't even know that it broke. So I'm willing still to work with this slope. I don't want to put too much emphasis on it, but I'm still willing to work with it. And you know, objective break of the weekly opening range, you're still looking for 87.27, but that's just the initial target. Downside break, I still think there's room for a big, for a bigger decline here. 86.71. And this above 618 retracement, this confluence region here basically gives you 86.30. So we need to see a close of the weekly opening range to finally get this at least near-term trigger to kind of look for this lower, but that's something that you want to take account on Aussie yen. So that is number 9. Number 10, last but not least, Pete, I didn't forget you, buddy. Oh, and Pete for the SPX too. So let's do DAX first because that's something that we did highlight earlier here in the week. Here's what the DAX looks like, man. It's actually pretty clean. It's actually pretty clean. And I'm not a big DAX trader, but you know, we were looking lower on the back of this reversal candle here in price. What can I say? This was our first sort of major target. You had the 100-day moving average converging right on the median line, which has been a decent pivot already in price. Resistance, break, saw acceleration, support, converge right there. So we're pushing lower. I have some extraneous slope lines that I just want to bring to your attention. So this slope right here is derived off the lows from 2016. If you take parallels off that high, resistance, break, support, little messy here, but the breach saw again acceleration. We rebounded it again off a support earlier to the beginning of the year, and here we are again. Now, my concern here is that you've posted an outside day reversal into fresh multi-week lows. Yeah, that can be a form of exhaustion on the downside in and of itself, which means you could see a bounce off that. But for me, on the DAX, I think for today, Pete, your focus should be on the close. Here's the near-term charts that we presented, right? So again, you know, looking at this from this standpoint within the confines of near-term price action, you're checking the lower median line parallel, and that converges on the 100-day moving average. We just looked at that on the daily chart right here. Look for immediate resistance at 1306, right? Immediate resistance there. The move lower, looking for 1296. Now, if you bring back the pitchfork that I just drew, a broader pitchfork, you can see that the slopes are almost identical. Here's the slope we were working with. Here's the broader slope. And again, if we break below the median line, you should expect to see some acceleration here. 1292, 12921 will be your first target. And then the 50 line, you know, it doesn't converge into the lows here, the 50% retracement. That doesn't take you out until like basically next week. But this is a 240-minute chart, keep in mind. But that would be your next downside target in the DAX if we were to break lower. Certainly a bearish sequence has manifested itself. This is the first oversold condition that you've gotten since the beginning of the year. And in my opinion, just foreshadows, you know, possible further weakness in DAX prices. As it stands right now, though, Pete, I wouldn't go chasing a fresh short exposure from here. If you're holding shorts, stops down to 13,127 would make sense. You know, if we break back through this region here, I think that would fundamentally change things in my humble opinion. But all things held constant, you know, you're still looking lower. You're still looking lower. Make sense, Pete? Does that help? Or Peter? And for Pete, he says, thanks, Mike. You're more than welcome. And for Pete K, who's looking at the SPX, again, I don't have near-term setups that I currently trade on the SPX, but here's the levels I'd be looking at. I guess the daily chart's the only thing that really makes sense here. Here's the slopes we've been working with within the confines of the last 4 years. And here's us hanging out back at the 50 line, kind of struggling after that reversal candle off the highs for the month. Momentum, I do want to note, this is the first break into oversold, from oversold territory since the start of the year. I tend to pay attention to these things. And certainly if we see the sell-off in bond markets continue, meaning rates move higher and risk sells off, guys, that could be the beginning. And again, I don't want to be a fear monger, but that could be the beginning of a much more adverse shock to broader risk assets. It would be a great opportunity for us in FX. I'll tell you that much right now, because finally we've got to see some of these ranges start to get out. But the risk is there. On its face value, here's what the intraday charts look like that we've been following. We've been talking about this ascending channel formation just off the yearly lows from December, the late December swing low. 1 touch, 2 touch, 3 touch, 4 touch, whatever you want to call that. There's the break, okay? And even on the flip side, the parallel saw resistance at once, twice, almost 3 times. So you have conviction on the slope. The break, well, you expect to see some acceleration, and you did. But where are we stopping right now? Former channel resistance, 1 touch, 2 touch, a parallel off the high, saw a 1 touch, 2 touch, 3 touch confirmed, 4 touch, 5 saw the break, support. Looks like we're breaking through that right now. So I have lateral support right here at 28,000 into 28,000, 2,800 into 2,807. Okay, 28.7. There's a nice little support region there. A break below this, guess where your next target is? All the way down at 2750, 2760. People might say that's crazy, but that's what the technicals are saying. I don't really care what people think. We follow what price action is saying. So curb your appetite heading into the U.S. trade session for the short side well above 2,800. That's all I'll say for the immediate term. And decent rebound, a decent recovery. If we do get another high, I think at that point we get to attach some sort of slope to this to give us guidance on the downside. But all things held constant, specifically what we're seeing in bond markets, I do think the risk is for this to start to correct lower. And remember, the high day reversal close comes in right here, 28.51. So I'll be looking for initial resistance on any recoveries right around that level. All right. Pete says, thanks. Have a great weekend. Hey, same to you guys. I want to thank everyone who joined. I'm way over on time. This is the longest I've gone over, but I wanted to make sure we got everything in. Don't forget, Jamie's going to be on board in just a little over an hour with midweek strategy webinar for a little bit more of a broader look at some of the swing trades we've been looking at and the larger themes that we'll be following heading into the start of February trade. Good luck tomorrow on the daily event risk with regards to NFPs. Watch for that NFP print. Again, expectation of 180 off of 148 the previous month. So anything, 150 and plus, I don't necessarily think you'll get a major market move. Anything northbound of 200, expect to see some sort of recovery, I think, in the dollar. And again, unemployment expected to hold at 4.1%. So keep an eye on that. Best of luck trading, guys, and I will see you next week. Welcome to February trade. It's always our favorite month. Me and Jamie are both February babies, so let's see if we can't give you a nice birthday present from all of us here at SB, guys. Take care. See you guys next week. Cheers.